Hey everyone, welcome back. Ready for another deep dive. Today, it's all about a metric that might sound simple at first, but trust me, it gets really interesting. Revenue per employee.
Yeah, it can reveal a lot about a business.
Absolutely. And for this deep dive, we're turning to an article by CJ Gustafson. He's a real SaaS expert. And get this, he compares the revenue efficiency of SaaS companies to, wait for it, venture capital firms.
Oh, that's a fascinating matchup. I'm curious to see how that plays out. You'd think tech companies would have the edge, right?
Yeah.
They're all about lean teams and automation.
Exactly. But the VC world operates on a whole different level, and let's just say the results might surprise you.
Okay, I'm intrigued.
All right, so before we get into this efficiency showdown, let's make sure we're all on the same page about what revenue per employee actually means.
Yeah, I mean, it sounds pretty self-explanatory, but it's worth unpacking a bit.
For sure.
At its core, it's beautifully straightforward. You take a company's total revenue
Yeah.
and divide it by the number of employees. It's basically saying, okay, how much value is each person in this company generating?
Yeah. And CJ calls it the GOAT metric, the greatest of all time.
And you know what? I kind of have to agree.
Right.
It cuts through all the noise, all the fancy financial jargon.
It just gets straight to the point.
It's a pure measure of efficiency. And the best part, it's super comparable across companies. You can put a tiny startup next to a massive corporation, and this metric still makes sense.
I love that. It's like a universal language of efficiency. No matter what industry you're in, you can appreciate the elegance of measuring output per person.
Exactly. It's about understanding how effectively a company is leveraging its human capital.
All right, so let's establish our baseline in the SaaS world. CJ's research shows that the median public tech company generates about $400,000 in revenue per employee.
Okay, that's a solid figure, a good starting point for our comparison. But of course, you always have those high flyers, the
Yeah.
companies that are just crushing it on the efficiency front.
Oh, yeah. CJ mentioned some big names like Block. They're pulling in a cool $1.7 million per employee.
Wow,
And Airbnb is right up there too,
really
around $1.5 million.
impressive. It's interesting to see how certain types of companies consistently perform well on this metric. Fintech companies and marketplaces, for example, they tend to dominate, especially at scale.
I was just going to ask you about that. Why do you think that is? What's giving them that efficiency edge?
Well, for fintechs, a lot of it comes down to automation.
Ah, makes
They've streamlined their processes to a point where they can handle massive transaction volumes with relatively small teams.
And for marketplaces, I'm guessing it's all about those network effects.
You got it. The more users they attract, the more valuable the platform becomes. And that drives revenue growth without needing to proportionally increase headcount.
Right, it's like a virtuous cycle of efficiency.
Exactly. The platform itself becomes a leverage point, allowing them to scale their impact with fewer people.
Okay, so we've got our SaaS baseline. Now let's step into the ring with venture capital firms.
All right, let's do it. I'm ready for the showdown.
This is where things get really interesting, but also potentially a bit tricky when it comes to making direct comparisons.
Yeah, you're right. Public investment firms often have diverse portfolios. They're not just investing in tech. So it's hard to isolate their performance in a way that's directly comparable to SaaS companies.
So to make it a fair fight, CJ focused specifically on early to mid-stage VC firms.
Oh, I see. So we're talking about firms similar in size and scope to, say, Benchmark, Index Ventures, or Founders Fund.
That's right. The firms that are actively shaping the tech landscape by investing in and nurturing those up-and-coming startups.
Okay, that makes sense.
It's still going to involve some estimation, but I think it gives us a much clearer picture of their true efficiency. Now, before we reveal those eye-popping numbers, let's take a quick detour and understand how VC firms actually generate revenue. It's not exactly like selling software subscriptions.
Yeah, it's a different beast altogether.
So where does the money come from?
Primarily from two sources, management fees and something called carried interest.
Okay, management fees sound pretty straightforward.
It's basically a percentage of the funds they manage.
So like a recurring fee for their expertise and services.
Exactly. Typically around 2% of the total assets under management, or AUM, of the fund.
Ah, so it's like a steady stream of income based on the size of the funds they're managing.
Right. But the real magic happens with carried interest, or carry, as it's often called.
That's the one that always makes my ears perk up. It sounds a lot more exciting.
It is. It's performance-based, which
Yeah.
means it's tied to the success of their investments.
So they get a cut of the profits when their portfolio companies hit it big.
You got it. When a company they invested in goes public or gets acquired, that's when the carry kicks in.
Oh, so it's like their piece of the pie when their bets pay off. But I'm guessing there's a catch, right? It can't be that simple.
You're right, there's a hurdle rate.
A hurdle rate, what's that?
It's a minimum rate of return that the fund needs to achieve before they can start collecting their carry, typically around 8%.
Ah, so they have to prove their worth before they get to share in the spoils?
Yeah.
Makes sense. So if a fund doesn't perform well enough, they might miss out on the carry altogether.
That's right. It's a high-stakes game, but the potential rewards can be astronomical.
And that's a key part of why VCs can be so incredibly efficient. That carry can generate massive returns, even with relatively small teams.
It's a powerful leverage point.
All right, I'm ready to see this in action.
Okay, let's crunch some numbers. CJ uses a hypothetical example to illustrate how this carry magic works.
Okay, let's hear it. My calculator is ready. So to illustrate this carry magic, CJ uses a hypothetical example.
He sets up a fund with $3 billion under management, and he assumes they have 20 employees for every $1 billion of AUM.
Meaning they'd have a team of 60 people managing that $3 billion fund.
Right. Now, let's say this fund delivers a stellar 25% internal rate of return, or IRR, over its 10-year lifespan.
Okay, so IRR, for those of us who don't live and breathe finance, essentially measures the profitability of an investment, right?
You got it. A 25% IRR means this fund is generating very healthy returns for its investors.
So walk me through how this translates into revenue for the VC firm.
First, we have the steady stream of management fees.
Yeah.
Remember that 2% we talked about?
Yeah.
On a $3 billion fund, that's $60 million in annual revenue.
Okay, a solid base to start with. But now let's talk about the carry, the potential game changer.
Right. After 10 years of compounding at that impressive 25% IRR, the fund's value would balloon to nearly $28 billion.
Hold on, from $3 billion to $28 billion, that's some serious growth.
It is. But remember that 8% hurdle rate? The VC firm only gets a cut of the profits above that threshold.
Ah, right. So they're not getting carry on the entire $28 billion.
Exactly. After factoring in the hurdle rate, the excess profit they can collect carry on comes out to roughly $21.46 billion. Now, if we assume a typical carry rate of 20%, well, you can do the math.
My calculator is smoking. We're talking about over $4 billion in profit just from carry.
It's a staggering figure. And when you annualize that over the 10-year fund life and add it to the $60 million from management fees, their total annual revenue comes out to around $489 million.
All right, drum roll, please. What's the revenue per employee with these numbers?
With their team of 60, that translates to a jaw-dropping $8.15 million per employee.
You're kidding me. Over $8 million each. That's over 20 times higher than the median tech company we talked about earlier.
It really underscores how the VC model, with its potential for outsized returns through carry, can drive incredible efficiency.
This is getting mind-blowing. And remember, we're working with a hypothetical 25% IRR. Imagine if a fund consistently delivers even higher returns.
Well, CJ explores exactly that in his next scenario. He imagines a lean, high-performing fund that manages to achieve a 30% IRR, still with the same $3 billion under management.
A 30% IRR! That's venturing into unicorn territory. I can't wait to see how that shakes out.
As you might expect, that extra 5% in IRR makes a huge difference. The final fund value, after 10 years, explodes to over $41 billion. And even with a hurdle rate, the excess profit subject to carry is over $35 billion.
Okay, someone hold my coffee. This is where my brain starts to melt a little. 20% carry on $35 billion. The numbers are getting astronomical.
They are indeed. That 20% carry translates to a mind-boggling $7 billion in profit for the firm.
Let me make sure I'm following this. We've got $7 billion from carry, plus the consistent $60 million a year from management fees. That's a total annual revenue of
$768 million.
Yeah.
But here's where the lean part of this scenario really shines. This fund operates with just 45 employees.
All right, hit me with the revenue per employee. I'm ready for the shock.
Hold on to your hat.
Push it.
$17.06 million per employee.
Okay, stop the presses. We're talking about efficiency on another level here. Over 40 times higher than the median tech company.
It really showcases how powerful the combination of high returns and a lean, focused team can be.
It makes you wonder if some SaaS companies might be looking over their shoulders at these VC numbers and thinking, maybe we could learn a thing or two.
It's definitely a thought-provoking comparison.
All right, let's come back down to earth a bit and look at CJ's third scenario, the scaled mega fund. What does he throw into the mix here?
This time, he imagines a fund with a whopping $10 billion under management. A bit more moderate on the returns, let's say a 20% IRR. And for this size, they've got a larger team, 30 employees per $1 billion of AUM.
Okay, so a much bigger ship with a larger crew but sailing in slightly calmer waters with that 20% IRR. I'm curious to see how this affects their overall efficiency.
Well, even with a lower IRR, the sheer size of the fund means their carry is still nothing to sneeze at. Over the fund's lifespan, they'd be looking at roughly $1.16 billion in carry.
And let's not forget the management fees. 2% of a $10 billion fund is.
A cool $200 million annually. Add that to the annualized carry, and their total annual revenue lands at $316 million.
Now that's what I call a revenue powerhouse. But with 300 employees, the revenue per employee is going to look quite different from our previous examples.
You're absolutely right. In this scenario, the revenue per employee comes out to $1.05 million.
Okay, still significantly higher than the average tech company, but not quite in the same stratosphere as those leaner, higher-performing funds.
It really highlights that while fund size definitely plays a role, it's that potent combination of IRR and a tight-knit team that seems to be the secret sauce for sky-high revenue per employee in the VC world.
So are we all feeling a little differently about the word efficiency after this deep dive?
It really makes you think, doesn't it?
Yeah.
We started with SaaS companies, and they were pulling in, a respectable amount per employee, but then bam, VCs enter the picture with these numbers that are just, well, off the charts.
It's not just that they're efficient, it's the scale of the difference that's mind-blowing.
Yeah, it challenges your assumptions about, like, where value creation really happens. Are tech companies really the kings of efficiency? Or are they playing a different game altogether compared to these VC powerhouses?
Well, speaking of playing a different game, CJ throws in one final bombshell in his article.
Oh, right. The OnlyFans phenomenon.
That's the one. He mentions that OnlyFans is estimated to be generating something like $31 million per employee.
Wow. Now, that's a figure that really makes you stop and think. It puts them in a league of their own, even compared to those high-flying VCs.
It's almost hard to wrap your head around that level of efficiency. What do you think are the key ingredients in their recipe for success?
Well, for one thing, they've tapped into the power of the creator economy. Like, they've created this platform that directly connects creators with their most loyal fans. No middlemen.
Which means lower overhead costs
Mm.
and potentially much higher profit margins.
Exactly. And of course, they operate in a purely digital space. Their operating costs are way lower compared to, say, a business that has to deal with physical products or, a ton of infrastructure.
It's a fascinating case study in how a well-designed platform can unlock this incredible efficiency. By empowering creators, by fostering these direct connections, they're creating a ton of value.
It really does make you rethink the potential of these new business models in the digital age.
So there you have it. Our deep dive into revenue per employee has taken us on quite a journey. From the world of SaaS to the fascinating and lucrative world of venture capital, and even a glimpse into the incredible efficiency of, well, OnlyFans.
We've seen how this one seemingly simple metric can reveal so much about different business models, about the power of leverage, about the potential for those outsized returns.
I don't know about you, but I'm walking away from this with a whole new perspective on efficiency. What's possible when you combine a smart strategy with, that laser focus on maximizing impact?
It's a good reminder that there's always more to learn, and that challenging those assumptions can lead to some really surprising discoveries.
If you found this deep dive as thought-provoking as we did, we'd love to hear from you. What surprised you the most? What are your own thoughts on efficiency in this, constantly evolving business landscape? Share your insights. Keep the conversation going. We're all ears.